Sometimes, stablecoins and variants such as algorithmic stablecoins function like historical names, as they refer to projects that call themselves stablecoins, such as Basis Cash, Elastic Dollar, Frax and their clones. The word stablecoin can be used as a logical description for a cryptocurrency designed to have low price volatility and has stores of value or units of account, or a new type of cryptocurrency that often have their value pegged to another asset, designed to tackle the inherent volatility. This goes against everything we know about how markets work. Circularity is the core issue, as I see it. The alleged deficiency of Bitcoin (BTC) as money and a vague definition originally inspired a host of stablecoin projects. The design features of these projects have now been incorporated back into the stablecoin definition. Haseeb Qureshi, a software engineer, author and famous altruist, defines a stablecoin as simply a price peg. Yet, it is not obvious that anything with a peg should bear the name of stablecoin. Amplefirth has a peg, and has been bucketed into the stablecoin category. The founding team routinely clarifies that it is no such thing. So, who is right? Another example of just what exactly is stable in a stablecoin, the peg or its value. Wrapped Bitcoin WBTC is perfectly pegged to Bitcoin. 1 WBTC will always be 1 BTC. Is that a stablecoin? According to the original motivations for creating stablecoins, BTC is not a stable means of exchange, even though Bitcoin is the canonical store of value asset. Having clarified the problem, that no one knows how to define or recognize a stablecoin, the rest of this essay outlines a solution. It provides a well-defined description of value as a relational property, namely, value in terms of a measurement unit. Using this description, I then comprehensively classify all digital assets along two dimensions: risk of loss, or the probability of realizing a decrease in value, and risk O. We can then precisely and logically define stablecoins, assets where the risk of loss and risk of gain are both zero. That is, P gain equals P loss equals zero. I call this a risk-defined stablecoin. It is clear that today's algorithmic stablecoins have a risk of loss but no risk of gain. Thus, not only are they not stablecoins, but they are terrible financial assets. I finish by considering whether it makes sense to expand the concept of a risk-defined stablecoin to a more general concept centered on expected value. An expected value stablecoin is one where the probabilities of loss and gain, weighted by the magnitude of loss and gain, are perfectly offset and I conclude that the complexity and ergodicity of such a concept rule it out as a useful stablecoin definition. What is value? What value means is not entirely clear, as evidenced by continuing debates about the true rate of inflation. We can ask, value in terms of what? That is, we decide to treat value as a relational property between the object being measured and the thing doing the measuring. It is like asking for height. Do you want it in inches or centimeters? For our purposes, can we define a function that maps an asset to a set of numerical values in a chosen unit? I call it value. For example, if the chosen unit is the US dollar, and the item is a bag of chips, value USD chips equals $5. We could just as well have written height inches table equals 35 inches. Risk of loss, risk of gain. The value of an asset changes over time, so we can expand our value function to reflect the idea of the value of an asset, in terms of a unit, at a certain time, by adding the time at which we are measuring value. Value unit asset equals X. We can define risks as the proba. In practical terms, this means that if I convert the asset into my chosen unit, I would realize a loss or a gain. A risk-defined stablecoin. We now have enough to create a well-defined description for a stablecoin. A stablecoin is an asset where the risk of loss and the risk of gain are both zero. That is, P gain equals P loss equals 0. This means that if I sell the stablecoin asset in the future, I will neither experience a loss nor gain in value, as measured in my chosen unit. The Boston Consulting Group's famous matrix was invented by the company's founder, Bruce Henderson, in the 1970s. With some rearrangement, we can repurpose the Boston Consulting Group growth share matrix to classify all digital assets by their risk of loss and risk of gain. The four categories are still stars, dogs, unknowns and cash cows. A star investment, with no risk of loss but a risk of gain, is rare nowadays but abundant in hindsight, such as when one regrets selling Bitcoin back in 2010. Stars also exist in the imagination. Such was the case with the investors in Bernie Madoff's fund. But those kinds of investments quickly reveal themselves to be dogs. Dogs are sure losers, there is no risk of gain, but if you hold them long enough, the risk of loss becomes an actual loss. Star investments are most abundant in hindsight when we can no longer buy them. Unknowns are your regular investments. You could be up or down in terms of value, depending on the day. Most digital assets, even Bitcoin, fall into this category. Lastly, cash cows are investments that have minimal risk of loss or gain. They are dependable. We can now take those projects that have been named as stablecoins to see which truly fit. Let's put some major digital assets and stablecoins into the gain-loss matrix. Projects called algorithmic stablecoins are stablecoins in name only. Because of their multiple token designs, they have no risk of gain, as all of the new supply is given to investors, but holders retain a risk of loss. Price peg is not enough. The expected value of owning an asset could be positive or negative, but it is not zero. Another lesson is that it is important to specify a unit when discussing value. Thanks for watching. Please subscribe and visit our website. Click link on description.